We are starting with the second session of Unido Talks. With us, we have Jonathan Knegtel, who is the CEO and co-founder at Blockdata. Welcome to the Unido Talks, Jonathan. It is very great having you. Seeing all the work you have been doing with Blockdata and the data, the research and insights Blockdata is producing. It's phenomenal. It's very insightful, and definitely we are getting ourselves. Being in the crypto custody business, I saw one of the posts where you have compared the crypto custodians, I think it is all coming out for free for us, but it is very insightful, and we are getting to learn a lot of things from the research you have been doing. So starting with that, can you please give us a brief introduction about your organization, how you entered the crypto space, what all motivated you to start Blockdata?
Sure, it's a pleasure to be here. So I've originally read the Bitcoin white paper in around 2012 and was just interested in the idea of, hey, this is a new kind of financial system that is being built that is underpinned fundamentally by a single source of truth, being a ledger. Ever since then, just been interested in following the technology. But after the 2017, let's say, bull run and then crypto winter that came after it, myself and some friends here in Amsterdam were looking at the market and saying, okay, it's great that there's so much information about, crypto assets, the pricing data and the on-chain data, but where is it where I can go potentially as a business to go and learn about the different applications of blockchain technology that I can then integrate into my business to take advantage of all of these new features that are being offered, not only by Bitcoin, but generally by crypto assets and blockchain. So that is where Blockdata, the way that we look at the ecosystem is that you have kind of blockchains in the middle that stores the data. Then you have the layer twos that may also store the data, but can also be, smart contracts and tokens, which are also applications. And then you have this third layer, which is all of these supporting services that may be custody providers, that may be exchanges, that may be other developer tools. And so at Blockdata, what we really try and do is map the ecosystem and make sure that we have all of the connections between all of these different, code bases, blockchains, solutions. So that makes it easier for somebody that wants to understand the space and actually get into the space. They can come to Blockdata and they can start to say, hey, well, I'm looking for all of the custody providers that are based in America, for example. And that way we can help them do their desk research a lot better. And then through our research, that is one of the things that that we've heard a lot from these enterprise and corporate and generally business adopters of the technology is so many concepts in the space are very, very complex, which we all know. We've probably all been in the space for quite a while at this point, but we all know it takes years to get up to speed. So that is where through the research, we're trying to simplify and almost flatten the ecosystem. So somebody that is maybe working in this organization who has been asked by somebody that wants to actually get Bitcoin on their balance sheet or start to integrate smart contracts, they can come across Blockdata research and it tries to simplify, what's going on. So hopefully they feel a little bit more confident with like, oh yeah, this isn't so crazy. This is really just a new data management technology and I shouldn't be scared of it.
Wonderful. You're making lives easier for us, especially for the new people who are entering the crypto and blockchain space. Especially the new companies, new enterprises which are willing to enter, still they are confused, want to figure out how they should be, what steps they should take. And obviously, the initial steps are hard because we are still learning. And definitely Blockdata, I can see it's making the initial steps very easier for not just for individuals, but for enterprises as well. So continuing with that, today's topic, we have to discuss, we will be discussing about institutional DeFi, and we are seeing the institutions getting attracted towards Bitcoin, Ethereum, cryptocurrencies, crypto as an asset class. On top of that, there are institutions who wish to provide crypto-related services as well. So this today's Unido Talks is going to be about this. So for our general audience, let's start with a basic definition. So in easiest words, what do you think, Jonathan, is institutional DeFi?
Yeah, so we have this whole area which is just DeFi, which is being decentralized finance, which is meant to be a permissionless version that anybody can partake in of the traditional financial system. So you have the traditional financial system here and DeFi over here. Institutional DeFi is another iteration of the DeFi, let's say, ecosystem and the protocols, where they're actually trying to play a little bit more in the middle. Now, what does that mean? Well, what they're trying to do is they're trying to look at what are the hurdles from the institutions that are moving from the traditional financial system into the DeFi ecosystem and saying, well, what's actually stopping them? And the main things that is stopping them is, for example, things like counterparty risk management. Do I know who I'm actually transacting with? And am I even able to have this asset on my balance sheet? So when we talk about institutional DeFi, we're talking about a group of services that are actually trying to cater and reduce those risks for the institutions that are entering the ecosystem.
This makes complete sense. There is a DeFi and there is traditional finance. And with institutional DeFi, yes, we are trying to find a middle ground. And institutions definitely want to probably, kind of disrupt this DeFi industry. And following this will be my question to Michael. You have worked in senior positions with Goldman Sachs. You know how institutions work, how especially the financial institutions, what their culture is like, how they work, how their operations are. What do you feel is attracting them about DeFi, and what kind of services these financial institutions can offer if they enter the DeFi industry?
Yeah. Look, financial institutions at the end of the day are there to serve clients, and the clients typically set the agenda. So until the last 18 months, banks have been quiet on offering crypto-related services because there really wasn't the mainstream push. Then it kicked off with JP Morgan, and a lot of the large American banks are following suit, where their clients are requesting. If you look at pension funds in Australia, for instance, each of the major pension funds, the superannuation funds in Australia, at their annual general meeting, there were questions from the members about what is the crypto strategy for the fund. So it's driven by clients. Now, institutions work, they're typically licensed, so they work within strict regulatory frameworks, and the frameworks are typically there to protect end users. So the institutions now are looking for how to bring what DeFi is typically designed around whatever the developer wanted it to work. The mechanics are written, it's very transparent, but at the end of the day, it was an individual or a group of individuals that wrote it. And I'm not necessarily talking about the latest offerings, but Bitcoin, for example, right? It was an academic exercise at the start. So then the institutions recognize that the clients want this class of asset, they want the risk exposure. So how do you deliver it? Do you sell them directly the coins and they hold? Do you hold direct exposure coins as a custodial product? Do you offer economic exposure on swap, where the bank holds the asset and they enter into a put call swap or a total return swap, where you settle a mark to market daily, so there's an economic return and the client never has to touch it? And I think Jonathan touched on this slightly earlier around what assets can even a company or a sophisticated organization hold. There's the practicalities of holding these things, but then there's the charter of an organization that maybe they're not allowed to hold indirect equity investments. It's probably totally silent on digital assets, for instance. So the banks are looking to be clever to meet client demand for exposure to the assets, and it's sort of melding exposure that they offer clients today, so the mechanics, so as I mentioned, swap or custody arrangements, to the underlying risk instrument, being Bitcoin or whatever it is. So we're going to see some interesting products come up, and then there's more fiat-based ones like margin lending, right? Where we've seen margin lending take off in crypto. These sorts of fiat concepts that have been around for ages, and melding the risk element, the crypto on the back, and how these things are offered, and the sophistication and who they're offered to is evolving, because regulations globally are not up to the levels that we would like. They're not prescriptive enough. So there's a lot of sort of reading between the lines and going to regulators and getting guidance. But this is all to do, this all is part of adoption, right? There are early movers that are institutions. There's some very large ones. The biggest bank in Australia, Commonwealth Bank, announced recently that they're going to be offering crypto solutions to their clients. Specifically what they are, we don't know, but one could presume holding and potentially buying and selling. So the demand is there. It's driven by clients, and the institutions work within the frameworks that their licensing regime, what they're part of, and it's what they can deliver within that regime. Because if you're familiar and comfortable with banks and you can get exposure to the new asset class, that's when this becomes mainstream. And the great example is credit cards, where you're paying in crypto, right? It's using a construct of fiat that's been around for ages. The underlying risk, however, is crypto. It's a great example, and I think we will see more and more smart, clever meldings of the old and new world, if you like, as regulation increases and people have some level of comfort, whether it be a bank or it's a Visa or a MasterCard, and the risk elements of crypto are there. And then you see the efficiencies of blockchain, for instance, for settlement and non-crypto specific, even just blockchain specific solutions. You've seen a lot of solutions in the NFT space for KYC and credit scoring and things like that. That's when this becomes mainstream, when these technologies are adopted. And the folks that are really going to push it on the masses are the institutions. So they play a very, very important part, in our opinion, or in my opinion.
Yeah, absolutely. Yeah. So continuing with this, what Michael said. So again, I think we are reaching a point where definitely we are seeing how traditional finance services can be offered in a decentralized fashion. We are seeing credit cards, debit cards of cryptocurrencies. We are seeing maybe banks coming out with maybe simple buy, sell, and holding services, custodian services, like in US. So, Jonathan, I mean, based on your research, you have also been seeing like maybe major companies working in this direction. So, just to continue with this, what do you think? What type of services come under this this institutional DeFi sector? And are there any other factors other than the client's demand, which is attracting institutions towards DeFi? Is there, like Michael also mentioned, is there some part of decentralization, a part of blockchain, a part of automation, smart contracts? So we have this technological part, we have economical part, we have financial part. So what do you think, like, is driving this demand, plus how financial institutions can satisfy this demand, and what type of services they can offer?
Yeah, so I think to start with the elephant in the room, the big one is inflation and super low interest rates. And that is where, when looking at digital assets and specifically Bitcoin, it is a new form of gold. It is digital gold in the truest sense of the word. And so for these large institutions that maybe have a lot of capital that is just sitting around, or even corporates that maybe have a treasury, having some exposure to an asset that by definition is, against inflation, is a logical move, and it should be part of a broader portfolio diversification strategy as per any reasonable logic, one could argue. So I think that's one thing in the direction. The second one, I think, is around the yield generating possibilities that exist within the DeFi ecosystem, and the fact that, a lot of things like lending and borrowing, which has been in traditional finance for, many, many years, is now existing on top of these blockchain systems. and the interest and yield generation possibilities are significantly times, like maybe 10 times or up to 20 times better than what you can get in the traditional world. And so rather than these players looking at the crypto and being like, oh yeah, that's a toy, now the conversation is being like, hey, this is actually serious. Like, why can't we get involved? What are the reasons that we can't get involved? And that, going back to how there's this jump from the traditional world into the DeFi world, that jump traditionally, or crypto, has been very, very big. But now, because the crypto world is building towards the institutions, it's easier for them to meet in the middle and to actually start adopting these services. I think as more and more people do it, it becomes easier and easier for their peers to also do it. So I think that's where, when JP Morgan, and I think it was Jamie Dimon years ago, said, oh yeah, Bitcoin and crypto is a complete and utter joke, and then he turns around, that can actually help, get other peers also involved in the ecosystem and treat it more seriously. When we're looking at the types of services, that's where, again, coming back to the way that Blockdata sees the ecosystem, where you have the blockchains, and the tokens, the protocols, and then the services that are now providing services into the ecosystem are hitting a stage of maturity and are becoming unicorns, which in the traditional sense of the world, a unicorn is a company that's, found product market fit, they're making sales, and they're actually providing a service that is useful, and they're hitting a level of maturity that you wouldn't get of a startup of 10 people. So as we're not seeing one, but we're seeing multiple, I think we're almost at a point now where there's 30 unicorn companies within the blockchain ecosystem. This is just a general sign of maturity, where also from a corporate perspective, when entering the space, or a Goldman Sachs or whoever, they're no longer having to work with a 10-person startup, but they're being handheld through the entire adoption journey by these organizations that have now not just onboarded one large company, but they're doing it, 10 times, 20 times. And this is something where, specifically talking about the custody providers in this space and how institutional focused they've become, this is where, they have good experience. And the last thing I'll say here is, we see this talent drain happening from the traditional finance world into the DeFi and blockchain ecosystem. But with that talent drain is there's a lot of experience and a lot of knowledge that is moving over to that world, which is then makes it easier for that world to then also adhere and can't think of the right word I'm looking for. Put everyone's minds at ease, and again, build that maturity. I hope I answered everything. That was a big question you just asked there.
Yeah. That's a very excellent, very insightful answer. I mean, as you mentioned, the companies have grown. They have matured so much that they are now in position, and also I would say in that stature that they can guide corporate institutions, big financial institutions, throughout the journey of adoption, like starting from the very first step, this is what it is, to even mastering it.
There is one thing I'd like to add onto this is something that we say a lot at Blockdata, and something that we see happening more and more is when Bitcoin first came around and cryptocurrencies, 2013, 14, 15, 17, it was always Bitcoin and crypto is revolutionary. And it's like, and now that the narrative is changing to, okay, it's not revolutionary, it's evolutionary in the sense of the upgrading of the financial system. And we've been arguing with large financial market infrastructure companies and just large companies in capital markets and finance for years at this point as Blockdata, where we're saying, guys, the sooner you accept that this is happening, the easier it will be for you and your organization to secure your position and secure your relevance in the market within this upgraded system. Some people don't like that, but I do think it's really important. If there's any institutions listening, it's one simple mental shift, but it can help you a lot when looking at this technology. Well, Michael, let me ask you a question.
Yeah,
One
please.
of the questions. What do you think? What do you think the institutions should be looking out for when they're entering crypto? Like, what are the key things that they might be looking at?
I think you should treat crypto the same as any other asset class when you're building a financial product. So whether you run a mutual fund or you're going to run a prime brokerage service, for instance, you have to look at how you deal with each asset. We've mentioned custody a few times, but it's super relevant. When you set up a fund, you need to specify in most jurisdictions how you're going to hold the assets. Is it a third-party custodian? Are you going to affect ownership directly? So you have to look at the facilities that are available, the infrastructure available in the crypto world to match what you do today. If you're running a long short equity fund, for instance, like a publicly traded fund. So custody is important. Settlement's sort of built into crypto, of course, because it's the nature of how the ledgers work. It's all in one. You have your transaction and it's settled. The risk management and the quantitative analysis. There's some really interesting projects out here which are taking big data feeds, breaking it down, applying AI to come up with buy, sell, pressure, demand, oracles, and things along those nature. That's not dissimilar to what the large brokerage houses do on New York Stock Exchange or ASX here in Australia. They observe, the buy-sell spread, and they determine what they think the short-term move is going to be. So I think you take the same approach that you would in any other asset class. You get to understand what's important, because usually it's legal and regulatory driven, right? You must have a custodian. You have to have a way of acquiring these things. KYC, it's the big unknown in crypto, because a lot of the trading is via DEXs and the incumbents do not cover KYC. So what comes of the DEXs when presumably at some point we'll get to a regulatory point, and especially this applies to institutions today, they need to know who they're trading with. So you're not going to have an institution trading on Uniswap because it doesn't meet their KYC needs. So you look for centralized exchanges, or you look at distributed DEXs where identities are known and the parties KYC against each other, or maybe there's a central system. But there's dark trading pools that exist today for non-listed equities in the US, for instance, which work off the same principles. So really, we're looking at the constructs that exist in fiat finance today. The equivalent is in crypto, and then you enjoy the efficiencies of crypto on top. I think it's quite important that we look for infrastructure which institutions don't conceptually already comfortable with, opposed to try and tell them, forget how you do business, this is the new way, because of course the regulators won't do that either. They want to run home to what is known, to what's comfortable, which is fiat. So it's finding the infrastructure in crypto today which matches how they run all their other businesses, all their other business lines. And I think, to your point, the maturity point of the industry, 4 or 5 years ago, we didn't have it, right? 2 years ago, we didn't have it. Uniswap's great, and everyone likes decentralized finance. It doesn't work for institutions. There are solutions that we just mentioned to get around the KYC issues, for instance, that are coming out. There's heaps of DEX projects with built-in KYC, because I think the projects are recognizing how important regulation is going to be. So I think the institutions need to look at the projects that offer the infrastructure to meet what they expect the regulatory requirements are going to be. And personally, I think the bet that the regulations that apply to crypto will look very similar to what they apply to securities. So I think going out there, seeing what's out there, and infrastructure which looks and acts similar, but the underlying asset is obviously crypto. That's what frankly, I mean, we're having conversations with instos. That's what they're doing. And I think it's the right approach. You future-proof if you accept these are going to be security-like in nature, running business the same way that you treat the other securities type trading businesses. And then it just comes down to what's more efficient. settling equities via third parties, and it takes time. You're moving money via Swift, takes time, costs money, or you're transacting on a blockchain that settles in seconds. There's no further settlement required. At the end of the day, for efficiency, blockchain wins, right? So I think if we catch up the fitting the regulatory mold and getting the right infrastructure, at the end of the day, I think blockchain comes first.
Sorry, 3 points which were mentioned in one of the blogs shared by Jonathan, was that by Blockdata. I mean, there were 3 points, and I think we have touched base on mostly 2 of them, which is about compliance, security, and connectivity. And these are 3 challenges, plus not only the challenges, these are also 3 very imperative steps which institutions need to take if they are onboarding into crypto or DeFi industry. So, Jonathan, although we have already touched base on 2 of these topics, can you please elaborate these 3 pointers, and what steps can institutions take when they are tackling these challenges in the future?
Yeah, so starting with the first one with compliance, as Michael was just mentioning, is especially when it comes to things like regulation, the regulators have taken a watch and wait approach, and they've kind of actually, because of that, it's been up to the ecosystem to innovate on how can we ourselves bring compliance into the industry. So that is where what we're seeing is by having KYC pools, as Michael just mentioned, it's enabling to always transact with known counterparties, which has always been one of the biggest problems in the crypto space. So if you have everybody KYC'd by default, that removes that compliance hurdle where I know who I'm transacting with, which allows me to adhere to more AML regulation, where I can now start to prove, hey, I know I transacted with this person, it's okay because I've done my analysis and I've done it's okay. On top of that, you also start to see, even for un-KYC pools, there are lots of companies that are doing the AML analysis that are assigning risk scores to non-KYC pools to see whether they're quote unquote poisoned by money or assets that should not be in there. So that is where there's a wide variety of different approaches being taken. But that is where, when you have things like the benefits of blockchain, like instant reconciliation and all of this, it can make the lives of compliance departments easier because you're always seeing something that is always true. When it comes to security, that's where we get into the custody and the storage of the assets, and how secure can I make those assets within my organization? For example, do I have to have multiple people sign a transaction? Do I store my assets in a web wallet? Do I store my assets in a hot wallet on an exchange or in my own custodian? Or do I store it in a vault somewhere under a mountain? So that is where you're starting to see, from a security point of view, depending on the risk behavior of the actual organization that is holding the assets, there are now many different types of options available, and there are increasingly more and more options coming to market. But to the point, in terms of the maturity of the ecosystem, a lot of these custodians didn't even exist in 2017, and they identified the need coming from the back of the last bull market, and we're like, hey, we've got to solve this, because ultimately these guys have a need for security. There are stories of crypto hedge funds of them making investments in blockchain companies off of Ledger Nanos, right? And it's like, no, this can't work moving forward. It's just not secure. And then the third one is around the connectivity. And that is really about, okay, if I store my assets and I have assets on my balance sheet, what can I do with those assets? Where I store my assets, does it allow me to interact with DEXs? Does it allow me to interact with smart contracts? And those are questions and like features that are not simple for people to build. And so that is where they are reliant on service providers to actually go and integrate these other services, all the benefits of the blockchain ecosystem into their custody technology, to enable them to then connect their assets into the outside crypto world and not just have it stored on stored somewhere. And for DeFi, that's really, really important, because if you can't interact with smart contracts, then your asset is just an asset, and it might as well be a bar of gold that you have on the bottom of a mountain. But that's not what crypto and blockchain is all about.
We should probably say Jonathan was not paid to plug all the important things that are important to organizations for custody and nailing everything that Unido does. That was coincidental.
No, but it's true. Like, this is...
We agree with you. We built a project around it. We totally agree with you. It's but it's funny, and it's, to your point, it's a maturity thing, right? Crypto has been an enthusiast exercise for a decade, and it works. If you're comfortable having X amount of money on a thumb drive, you'll do it. It's your money. Organizations, as you've highlighted, don't work that way. They have their charters on how things need to be dealt with, and they need a totally different paradigm. And filling the gaps now is the maturity. And there's some really good projects, I mean, aside from custody, that are working in the space, filling the gaps. And, you know, we're light years away from 4 years ago in 2017.
Yeah. And one extra thing to add on top of that is now there's also a trend of, also of insurance, disaster recovery, and all of this stuff, that now the insurers are also starting to switch on to saying, hey, like, maybe we can also partake in this ecosystem as well.
It's really interesting. I spoke to a reinsurer about a month ago regarding a theft loss. And when you go through the reinsurance process, it's a lot like private equity placement. You go see the reinsurance syndicates in, you know, London and Bermuda. The appetite for this sort of risk is there, which is interesting, because it means that the underwriters and the reinsurers are putting time to understand the technology, and they're taking the actual physical risk, which presumably means if they're hedging against a Bitcoin downturn or contract failure, they're either shorting certain coins, they're taking positions. So if you've got institutions that are getting comfortable to a degree that they're looking to build their knowledge around this and actually take positions to offer what is a real world product, an insurance contract, a counterparty product, it's nothing to do with crypto. And it's based on the capabilities of smart contracts, and the risk exposure is they're obviously taking a position long or short in coins. That's a really big indicator that such large reinsurers are getting stuck in. I take a lot of comfort in seeing those moves.
Sure. Yeah, continuing with the same thing. So as you mentioned, like institutions, if they want to use DeFi products, obviously we can't go for something like a locked custodian, or I would say, like, we have to design the products in a very different way. If institutions are entering the DeFi space, and as you mentioned, the organizations are now that much mature that they can handhold, and they can walk through the entire journey and about the products. So touching base on more on the product development and the project management part, like, what do you think, are there any differences which the product developers can bring? So again, this is, earlier we were talking about institutions to crypto. And now we're talking how crypto products can move towards institutions, so that institutions become more friendly, more adaptable, and of course, it accelerates adoption.
Yeah, so I think the prime example is our products like Aave Arc, where they're actually bringing out, they've had their permissionless pool for and their permissionless product for quite some time now. And they were getting a lot of interest from the institutions, and that has fundamentally changed their product roadmap. They want to continue building out their permissionless ecosystem, but they are also going to be bringing out a permissioned version, which has those KYCs and compliance features that we've been talking about. Now, that is something that unfortunately is not just turned on. As with any smart contract-based product that is on the market, these things take time, and there's a lot of testing and iteration that needs to happen. But that is where those things are becoming easier, because they can become reliant on other companies and protocols from the space. For example, in the case of Aave Arc, they are working with Fireblocks, which is a custody technology provider, to provide some of the KYC services initially on top of their permissioned part of the protocol. Now, over time, it is their vision that they would have multiple KYC providers, not just reliant on one. But I think this is a prime example of a protocol, a DAO, or whatever we want to call it, being asked by potential users saying, we want to use you, but we can't use you in your current state because we need certain feature sets. And this is becoming back to Michael's initial point around, hey, look, the institutions are coming on board. That's where now they're starting to understand these user requirements. And because of this talent movement that's also happening, there are people now working at these organizations and these protocols that have that inherent and deep understanding of what the traditional players are looking for when deploying capital into the space. I think that's the simplest answer I can give.
For sure. And one of this, it is exactly what Michael is also helping us do. Like, he also comes from a very traditional finance background with Goldman Sachs. And definitely he has helped Unido to also develop a product which caters to the demands of these financial institutions. Michael, a similar question to you. So for example, Fireblocks kind of transform how custody services are provided, plus building an enterprise platform with it. Similar kind of thing we are doing with Unido. So we are addressing issues like corporate governance. We are addressing issues like with the self-custodial wallet. Again, we had this discussion in the previous Unido talk also, where we are, the custody services are also, again, pondering self-custody versus locked custody. So seeing our product suite, seeing Fireblocks product suite, maybe generalizing it, like, what do you think how these DeFi products, custody services, asset management services, they can be transformed or they can be slightly changed so that they cater to the demands of financial institutions?
Look, at the end of the day, financial institutions are like other institutions, that there's a level of sophistication for their decision making. So the approval process, for instance, if you have a margin loan in prime brokerage and you're going to release assets, it's not one person that will hand the assets over. There's various subsystems, electronic subsystems, which provide data input, whether the account's collateralized appropriately or reads into what the covers are required, and so that you don't breach covenants. So there's multiple steps, and there's multiple subsystems. Then there's natural persons that will make decisions. There are multiple steps to get into a decision to move an asset. And this comes back to multi-party computational models like Fireblocks, like Unido, where if you can remove the middleman, at the end of the day, that's what DeFi is, right? Removing the middleman, removing individual choke points. So having the idea of fragmented keys, for instance, that's using a technological solution to match how institutions work. And this is very important. We touched on. Don't try to tell institutions you need to rewrite your business to be involved in crypto. We need to find very smart technological solutions to mean crypto is accessible to institutions. MPC is a great example. Fireblocks, we've talked about them previously. We've done comparisons with them. We're very big fans. We went in the same style of business with them, as them rather. So there's these sorts of pioneers that are identifying that organizations are different. Let's build solutions around them. And then there's smart solutions which are crypto-centric. Hypersign, one of our partners, is a similar one with the digital ID for KYC process. At the end of the day, it's accepting that KYC is important. Identifying someone on-chain is important. So using the idea of a token with an ID attached to it is an on-chain solution for an off-chain requirement. So again, it's clever solutions which either working and adapting crypto to work with off-chain providers or fiat providers, or working from the other way in, accepting this regulation and providing on-chain solutions to it. But I think it's just, my takeaway from all this, and I always keep coming back to it, is the solutions need to work with how these institutions work today. And they're not going to shift their business and instead of issuing credit cards or online banking, hand out thumb drives, right? It's not going to happen. So the solutions need to meet how their fiat banking works today. So that's what's important with the providers like Fireblocks that have been doing it. I think 2018 they kicked off, and they've been around. Unido, of course, we started at the start of the year. It is just bridging this gap, and there's still a gap, and that's what we're building, of course, at Unido. But that's just custody. There are gaps left, right, and centre, and there's new projects popping up. And some hit the mark, some have an interesting way, it's changed a bit, which is important because it leads to innovation too. Regulations will change and innovate. So having some projects which lead the way and do things a little bit differently, if there's gains in efficiency or for whatever reason they choose to do a different way to how fiat is conducted, for instance, fiat transacting, that pushes innovation too. Then we've got the lobbyists who sit with the regulator and say, X, Y, and Z works to map crypto regulations similar to fiat, but hang on, there's Z, and this is a new way of doing it. And this is why blockchain is so powerful, because you sort of reimagine everything from the ground up, and that's what's exciting. So if you combine the service providers building the interface for institutions to work with crypto, and then the innovation factor, that's where we get exciting, and that's where crypto comes first and fiat will come second.
Absolutely. Yeah, I think this is going to be very much the title of this entire webinar when I'm going to upload. That yes, what Jonathan said, we are shifting from revolution to evolution. The two industries are shaking hands, and the moral of the story is, yeah, let's work together. If you want adoption, at a very massive scale, we have to shake hands. That's the right path. One thing we were talking about, and it was a very heated debate in, I remember 2017, 18, about security tokens. And like you mentioned, Michael, in the eyes of law, crypto assets can be treated like securities. The rules can be very similar because they have been treated similarly by the investors as a medium of growing their returns, growing their portfolio values, etc. And at that point of time, we saw security tokens everywhere. Now we are seeing tokenization of assets. We are seeing NFTs, and the hype, which is justified, NFTs have got. It's tremendous, and it might be something which institutions have not started to look over, because right now we are seeing the NFTs are mostly for digital arts, for artists, for gaming, especially in this artistic industry, creative industry. But Jonathan, do you feel that maybe tokenization of assets, and sometimes I feel mostly about real estate and NFTs, do you think they in some part catch institutional attention? And is there a way that institutions can explore a way to deal with these NFTs, tokenized assets, and this part of the crypto space?
The short answer is it's inevitable. And coming back to this evolution thing as well, is what at Blockdata we've held the viewpoint that it doesn't matter what you're tokenizing, be that a JPEG, be that a physical asset, be that real estate, be that another financial instrument like a loan or something. The process that you're going through from a technical point of view is very similar, if not the same. when you're issuing an asset on a blockchain. So what we say at Blockdata is we call it the great asset migration, where over the next decade, the amount of assets that are issued on traditional infrastructure will go down, and the amount of assets issued on modern blockchain-based infrastructure will go up. And at some point, there will be this flip moment. And I think that is where it's about how do we bring the benefits of blockchain, like instant settlement, like reduced participants in this financial system, increased efficiencies. How do we bring that to all assets all around the world? Be that, things like around climate change, like carbon tracking, that's important, that's asset tokenization. Be that power grid management, asset tokenization. Through all of these different instruments, and all of them do have their own specifics. But that is where blockchain innovation is happening in a very generalized fashion. And it doesn't matter if you're using Ethereum as a smart contract platform, as a cloud computer, or you're using Quorum, Corda, Hype, or versions of Hyperledger. These are all general purpose platforms that developers and institutions can code to their own requirements, depending on whatever there are and whatever asset there is on tokenization. Now, it does bring a host of other problems. For example, how do you tokenize a physical asset? We may have things like actual, hardware that is required to be put into machines to actually verify this information. But that is where, looking forward over the next decade, it's important to not just look at blockchain as one of the things that's going to enable this to happen, but looking at all of these new technologies from IoT, from AI, from AR and VR, and then thinking, okay, well, how are we actually upgrading the entire infrastructure to how we manage data, of which blockchain, does manage one of the most important things in data, which is what is true and what is not true. All of the other technologies are focused around, how do I interpret data? How do I look at data? How do I interact with data? Whereas blockchain is the only one that says, hey, this is the data that's actually true. So I think taking a little bit of a step back and going, to NFTs, we've seen NFTs evolve over, since 2017, right, with CryptoKitties when that first came out. And as with many of the things, be that ICOs, STOs, NFTs, it really does happen in waves in the ecosystem. But at the end of the day, if you take it on a bigger time horizon, it comes back to maturity. And with STOs, after the ICO hype in 2018, STOs were all the rage. Everyone was like, we're going to do STOs, but that's where the regulation wasn't there. The compliance in place, was not there. And now again, we're starting to see, these are starting to come back, and we're hearing stories, even though it is hard for us to verify as Blockdata, as a market intelligence firm, that there are tens of billions of dollars worth of assets that are now being tokenized in jurisdictions all around the world and being put on blockchain-based systems. But these are not JPEGs being tokenized. These are equity. These are loans. These are bonds. And so we are at the very beginning phases of this upgrade process that I mentioned at the beginning.
Yeah, absolutely. This is where the future of not just DeFi, but the crypto is heading towards. And you mentioned what is going to be tokenized into a blockchain infrastructure. The potential is enormous. And right now we see anything can be. We are seeing JPEGs, we are seeing equities. They are two very, different, they do belong to very different spaces. Michael, what do you think? Is this future like where we are seeing tokenizations, plus where we are also seeing the institutional DeFi getting it's expanding. So what do you feel like is the future of institutional DeFi like? I know this question is a bit abstract, but you can cover all the points.
No, I get it. The situation as it exists today in most jurisdictions is, when it comes to tokenizing real assets, they get held in a vehicle, a special purpose vehicle, and then you issue capital out of that vehicle, which is typically debt, equity, or hybrid in between the two. So there's an application immediately today, and Jonathan already covered it, that Blockchain is just a record of who owns what. So you match the token to something in the capital structure, such as equity. So the regulations and the legal constructs exist today to put an office building, some allocation of coffee beans, a reinsurance contract, a non-performing loan portfolio into an SPV, and then you recognize the equity held by tokens. So the tokenization is just the ownership of the equity. What I think will be interesting going forward is, will we get to a point where tokens, we've got our designation of utility tokens, for instance, which doesn't give you, it gives you a right to use the blockchain. It doesn't give you access to a third-party asset. So are we going to find a new designation in the capital structure, for instance, where a token entitles you to something? And what's the format going to be? Is it going to be a total return swap where the counterparties, where it's like a globally issued TRS documentation, and you have a right against the counterparty based on if you own the token or not? There's so many different permutations of how you could structure a token against a legal entity. And then do you do away with the legal entity? Is the trust, the deed ownership of real estate, does that get tokenized directly? These are the really interesting steps, and which require huge leaps in regulation, because the concept of tokenizing a contract without a counterparty, just that there is a right to claim against it, don't really exist today. But you could imagine if we put on our fantasy hats, that you get there, that a smart contract could enter into a trust deed, for instance, to buy some real estate, and then the beneficiaries of the smart contract are the token holders. Those are the sorts of steps. They're not soon, they're not this year, they're not next year, they're not the year after, but they're on the evolutionary spectrum. And this is where you leave fiat behind, where you leave it for dead. When you start fractionally owning or security tokens, which aren't artificially wrapped in legal entities today. We do it today because that's what the regulations are. That's how you hold assets when it's not a natural person. You put it in an SPV. We will get to a point that these things fall away, I'm certain. And once you do, and the efficiency, so you haven't got to run a company, we have formulated rules of how you issue these, and you KYC the buyers, and they're traded on exchanges with KYC. So they meet securities-like rules, but you do away with the unnecessary corporation, if you like, that you would typically use as a wrap or a repack that we used to do in banking on a daily basis. That's where this really starts to rocket. And that's where you have sort of a DeFi version 2 as far as the instrument type. And that's what I'm quite excited about, because once then you have true tokenization of assets. As I said, it can be anything. It could be a loan portfolio. It can be coal on a ship. It can be electricity, medical records, anything.
One thing I wanted to add on that, which I think is also what some people forget about this ecosystem, is when that starts to happen, it has network effects built in. Like if one company tokenizes their equity, they're more likely to also go on and tokenize other aspects of their business or pay using crypto payment rails. So that is where we are getting to a point, and it's up to anybody to say when it is, but at some point this will become exponential in terms of growth, and specifically around the business usage. We're not talking about consumer crypto.
Yeah, adoption. And non-crypto adoption of blockchain drives these things. You touched on carbon emissions tracking, industrial uses for blockchain, which aren't crypto related. There's value in capturing the information or the trading, or you could use it presumably for recording legal wills. It's a mutable record of what you wanted. Those sorts of industrial uses, when they're accepted, that's what really kicks these things on. And I think we're getting there. There's really interesting uses for NFTs today. For instance, in the sort of individual ownership space, Moda's doing great things in the music royalties, for instance. It's a great example of not necessarily crypto, but transferring of rights and right recognition. That's when I think we really kick on, when, you're willing to buy your music rights on an NFT, you know, instead of buying via Apple, a centralized provider, or going, you know, through the usual license rights. That's where I think this really kicks on. And of course, these things need to be held. They need to be owned. Your NFT of a JPEG, whether you think 180 million bucks is fair or not is irrelevant. The market paid for it. These are valuable assets at the end of the day. They're not utility tokens. And there'll be the new class of these things. And again, it comes back to, we need the infrastructure to hold these things. The banks will recognize someone paid 180 million bucks for a JPEG. That is a valuable asset, whether you agree with it or not. It needs to be held. So it always comes back to, where's the infrastructure to facilitate ownership of value at the end of the day. Utility tokens are valuable, stable coins are value, things that are deemed securities as of today are valuable. Building the infrastructure to hold this value, and then it evolves when you go beyond crypto, tradable assets, like we touched on, NFTs, carbon credits, all that sort of stuff. You need the infrastructure to hold them. You need the infrastructure to write them, and it needs to work for organizations and not some guy with a Web3 wallet who you know, is tech savvy, because the vast majority of us are not. And Web3 is not straightforward by any means for these sorts of, especially new projects. So it always, for me, and I keep banging on about it, it always comes back to the simple infrastructure, which means the mainstream can work with crypto. Crypto needs to meet mainstream, not drag mainstream kicking and screaming into it.
Yeah.
Absolutely. Again, coming to the same point, revolution to evolution. Amazing. It was a very insightful session. And I think we have come to an end. We have touched 1 hour mark of discussing this entire topic. And yeah, we have covered almost every aspect of institutional DeFi, its adoption, acceleration, future, current status, like everything. And most importantly, how much traditional finance and DeFi need to understand each other, shake hands, and move along. Thank you so much, Jonathan, for joining us. Thank you, Michael, as well. It was great having you too. And the video will be going out live possibly tomorrow or the day after. Definitely, I'll share the link with you, Jonathan. And
perfect.
Yeah, please stay in touch. If there are any similar sessions in the future where we will talk about some other topics, especially what you are researching about in Blockdata, I would love to invite you again.
Yeah, guys, it's been an absolute pleasure. Thanks ever so much for the time and the invitation. I'm looking forward to keeping in contact.